In the last video, we have learned how to prepare receipt and payment account. In this video, we learn how to prepare income and expenditure account. Now, when you talk about income and expenditure account, remember, in this income and expenditure account, what entries we take? In a receipt and payment account, what entries we take? Where cash flows in, where cash flows out. If there is flow of cash, we enter that in receipt and payment account. In income and expenditure account, we are not concerned with the flow of cash, but we are concerned only with the revenue items. Let's see. Here, what we take is all revenue items. Revenue items means it may be a revenue receipt or a revenue expense. We take it in income and expenditure account. Capital items are not to be entered. Capital expenditure and capital receipts are not to be entered in income and expenditure account. Capital receipt means non-recurring receipt. Legacies received, donations received for endowment fund. We don't enter that in this account. Capital expenditure, when a new asset comes into existence, when there is improvement to the existing asset, and when there is discharge of fixed liability, that is a non-recurring expense. It's a capital expense, not to be taken. Here, second part, we are not concerned with the cash or non-cash items. All items are to be taken. Like if there is any outstanding means what? Either still to be received or still to be paid. All items are to be taken. Outstanding, nothing but even non-cash and cash, all transactions are to be entered. The very important thing here is we only record the revenue items, and cash, non-cash, we are not concerned unless and until it is revenue. We have to enter that in income and expenditure account. Now, income and expenditure, what to debit, what to credit? Simple. What is the rule for income? The American accounting system rule for income. So if you find out that income increases in the account on the credit side, if the income decreases in the account on the debit side. Moreover, the rule for expense, these are the two rules. But usually you go through the rule of income. We'll see what happens to the income, what happens to the profit. Like for example, salary paid. What happens to the profit? Profit decreases, income decreases, debit. Rent paid, profit decreases, debit. Interest received means income. Your profit will increase, we credit. That's all. Using this rule of income, we'll prepare income and expenditure account. Now first, let us take up a problem on this income and expenditure, and then we'll see how to record that in the account. So this is the problem given. Receipt and payment account provided by Arogya Hospital as on 31st March 18 and the additional information. From this, we'll prepare one income and expenditure account. As I explained, remember, only revenue items are to be taken. Capital items are not to be entered in income and expenditure account. Let's see. First, we'll consider the receipt side. What is the first one? Subscription. Subscription is nothing but the annual membership fees that we receive from the members. We receive it every year. It's revenue. Revenue items are to be taken in income and expenditure. Then the question is where it is to be taken. Subscription is an income. When you record the income, your profit will increase in the profit. We credit. On the credit side, we record that as subscriptions. The amount of subscriptions is 60,000. I am taking it in the inner column because we have adjustment. That adjustment will take up afterwards. So for that, we'll leave some space to get the adjustment done. Entrance fees. Entrance fees, 2000. Now when you talk about entrance fees, it may be capital or revenue. It depends upon the problem. Is it mentioned anywhere? Entrance fees are capitalized? No. That means entrance fees are revenue in nature. Revenue is to be recorded. Entrance fees, receipt side, it's income. When you take up the income, your profit will increase in the profit. We credit. Entrance fees. On the credit side, rupees 2000. Next, endowment fund. Endowment fund, as we have learned in the earlier videos, it is a capital receipt. Capital receipt is not to be entered in income and expenditure account. Where we enter, we'll see it afterwards. But in this account, endowment fund 50,000 is not to be taken as it is capital in nature. Let's see the next one. Donations. They have not mentioned here donations. What donations? Special, general. So let us see the adjustment. Here, donations are received for a special purpose, and we know that when the donations are received for a special or a specific purpose, we call that as a capital receipt because we receive it only once, non-recurring in nature. So again, these donations are also not to be taken. Endowment fund and donations we have not taken because they are capital receipts. Next, fees from patients. But obvious, it is revenue. Revenue is to be entered here. It's fees, it's a income. Income will increase your profit on the credit side. Fees from patients, rupees 2,500. Next, interest received. Interest, do we receive only once? We receive interest monthly. We receive interest monthly, quarterly, half yearly. That means in short, we receive it again and again. It's an income, we will record it as an income. Interest received. The amount 200 rupees. Sundry. Sundry means the small receipts which are received again and again. So that is again going to be a revenue receipt. Enter it. Sundry receipts. Revenue receipts are to be taken into consideration. Rupees 300. That's all with the receipt side. Now let us go through the payment side. Instruments and equipments purchase. When you purchase the instrument and equipment, the hospital is purchasing it. We say that a new asset comes into existence. New asset comes into existence means this is going to be a capital expenditure, not to be taken in income and expenditure account. Furniture purchased on 1st April 17. Furniture purchase means again a new asset comes into existence. It becomes your capital expenditure, not to be taken. Next, diet expenses. Diet expenses are the regular expenses, the recurring expenses that are incurred by a hospital. Will record it. Diet expenses, rupees 2,500. Medicines purchase. Medicines purchase of hospital means not asset. Medicines purchase is a revenue expense. But do we have any adjustment on see medicines purchase? Yes. Something we have here. We'll see what is to be done with that. So medicines purchase will take in the inner column because we have some adjustment on it. We'll show it as medicines. Rupees 5,200. And immediately a line is left for the adjustment later on. Salaries, monthly we pay. So it becomes a revenue expense. We enter it in the account. Do we have adjustment on salary? No. So salary is in the outer column. Salary 10,000. After salary, what we have is office expenses. Rupees 3,800. Office expenses is again an expense. Revenue expense. Any adjustment on that? Yes. Let us take up in the inner column. Office expenses. 3,800. We have adjustment. We are leaving a line for that. Government securities in the receipt and payment account means in the cash account on the payment side. Means they are purchased. When you purchase the government security, it is called as investment. Investment means an asset. A new asset comes into existence. New asset comes into existence, so that is your capital expenditure, not to be taken here. What is the next? Balance carried down. Closing cash balance will come in the balance sheet, not in income and expenditure account. So from receipt and payment account, these are the items we have taken. Now the next question arises, where are these items to be taken? We'll see that in the next problem when you prepare the balance sheet. Revenue items in the account, capital items in the balance sheet. That we'll see in the next problem. Adjustments. Now we are learning from PUC 1. Every adjustment should have a double effect. When you prepare the final accounts. Here we are preparing only one income and expenditure account. So every adjustment in this problem will have one effect. In the next problem, when you prepare income and expenditure along with the balance sheet, every adjustment should have a double effect. One in the account, one in the balance sheet. In this problem, one at every adjustment, one entry. Donations are received for a special purpose, yes, and that is the reason why we have taken it as capital. So this effect already we have given. Next, outstanding subscriptions, rupees how much? 2,000. How much subscriptions we have received? 60. Outstanding means what? Still 2,000 we have to receive. What we have to receive still is our income. How much received? 60. Still to be received 2,000. That means your total subscriptions are how much? 62,000. Let us add it. Add outstanding subscriptions, rupees 2,000. In the outer column, 62,000. So this is the transaction what we have done. Outstanding interest on government securities. Government securities are investment, it's asset. Interest on the asset is always income. It's outstanding. Whether it is received or receivable, paid or payable, it makes no difference in this account. That is only to be seen in the receipt and payment account. Because in receipt and payment account, in this account, we show only cash transactions. In this, all transactions. Cash, non-cash, provided it is revenue in nature. Now interest. Interest on government securities. Interest we receive again and again. So that is a revenue receipt. Revenue receipt is to be entered in the account. Let us enter it as outstanding interest on government securities. On government securities. The amount comes to 7,000. So the effect for this end transaction is been done. Office expenses are outstanding, 200. How much we have paid already? 3,800. Still we have to pay 200. So how much are total expenses? 4,000. Let us add that. Here, add. Outstanding expenses, which comes to 200. In the outer column, 4,000. Depreciation. Depreciation, nothing but decrease in the value of asset. When the value of asset decreases, naturally the profit will decrease. Decrease in profit, we debit. Decrease in income, we debit. So let us debit depreciation. Here, let's see how to record it. First, we'll give the heading as depreciation. On what we have? Instruments and equipment, what percent? 20%. Instrument and equipment, 20% of the value. What is the value? 40,000. Of that 20%, what we get is 8,000. We'll take in the inner column total and we take in the outer column. Further, on furniture 10%. Furniture how much? 10,000. Purchase on what date? 1st April. That means on the first date. We'll provide depreciation for the full year. If it is purchased somewhere in the middle, then we'll take the months into consideration from the date of purchase till the year ending. Here purchase on the opening date, so depreciation for full year. 10% of 10,000, which is nothing but 1,000 rupees. Furniture 1,000. Total depreciation 9,000. So we have finished this outstanding, we have finished depreciation. Last, stock of medicines 700. How much medicines we have purchased? 5,200. Of that remaining with us, stock means remaining 700. 5,200 purchased, remaining 700. So how much medicines are used during the year? 5,200 minus 700. Medicines used, medicines consumed are 4,500. Here, less stock. 700. When you minus it, what you get is 4,500 in the outer column. That's all. This is how we post the transactions. Only revenue items. Now let us balance it. See which side total is more. If credit side is more, income is more, we get a credit balance, profit, surplus. If debit side is more, we get a debit balance, what we call as a deficit. Let us see what is the total. So the total, the credit side total is more, what comes to 74,000. Write the total on both the sides. Now from this 74,000, let us minus debit side. This is 7,010, 17 and 4, 21 and 9, 30,000. 74 minus 30,000. What balance we get is 44,000. What balance is this? Credit side total is more. Credit balance. Credit balance means nothing but your surplus. Surplus is what we have got by balancing the account, what we call as balancing figure. This surplus we carry forward to the balance sheet.